Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest. We've got Dusten Hendrickson. Dusten, appreciate you coming on the show.
Hey, thanks for having me, Darin. I appreciate it.
Absolutely. So a little bit on how we know each other. This is actually our first time talking to each other, but I reached out to Dusten. I'm interested to see what he's got going on, man. This guy's he's on a bunch of podcasts and he's doing good things, and he's in a different market. So I want to get an understanding for that market also. So with that, can you share with the listeners a little bit about how many properties and how many units you're invested in?
So I have about 15. I'm invested in about 15 passively. So I'm just an LP in those, and that's about 2,000 units roughly. And then I am partners in over 1,000 units where I'm on the GP team. And my percentage ranges from anywhere from 100% of those projects up to, 5% of those projects, maybe even 3%, some of the big ones. What we focus on now though is wellness design, modern workforce housing. Basically, we take an A-class.
Wait, slow down. That's wellness design.
Yes.
Wellness design. Finish out the
modern workforce.
Modern workforce. Okay. So what does that mean?
It's basically housing for professionals, young professionals. It's a really nice interior. It's all stripped out amenities. So you don't have to pay for all these amenities that most people aren't using. And right now, stuff's so expensive, you're having to cut some things. And so what we're cutting is the amenities, and we're noticing that some people appreciate it. Most A-class buildings have tons of amenities. There's very few A-class buildings that don't have any amenities, and we find that they do really well.
Awesome. So is this, like I've heard, I have not been a partner or anything or invested in any of these types of deals, but I've heard of them in some of the urban markets where it's almost like a young professional dorm. Like there's kind of more hangout areas, but the actual rooms are smaller. So is that the way that these are designed, or is that different?
What we're doing now is not exactly like that, but yes, we do some of that stuff. If we're in a more urban setting, that's what we do. But right now, we found that suburban areas the return on investment's much better at this point in the cycle. People really want to have a little more space, like a little more green space. Units are super nice. They're very close to town. They're just not in town. And then the rent is cheaper per square foot.
So what amenities are you taking out?
Dog parks, pools, garages, any common space that we can eliminate. So we're trying to eliminate hallways as much as possible now, because they're a huge maintenance cost, and you got to heat them, and there's a lot of square footage there. So as much of those we can remove as possible.
It's so interesting hearing this other side, because I've talked to so many syndicators that are in, I'm in Dallas, and I know a lot of syndicators in Dallas and Houston, San Antonio, and a lot of them have kind of shifted up from the BC into the A minus, B plus area, and they all talk about amenities, the pool, the gym, the having a really nice office, having the lockers, so having a cool outdoor, barbecue area, like all these different amenities is what they talk about to try to attract people. Yet you're looking at it from the other side saying, you know what, people aren't using a lot of that stuff. And so we can take that out and then have the consumer, the tenant, save money.
Well, I mean, amenities used to be new 5 years ago, 10 years ago, but everyone does amenities and everyone's going so overboard with the amenities. When I walk through most apartments, no matter what the amenity package is, it's almost always unused. Even the decking, people don't even sit out on their decks. So majority of the time, people are at work, sleeping in their apartment or inside their apartment. They're very rarely on the grounds, honestly.
Right.
So if all the A class has amenities, because it's always had the amenities, well, we have A class that doesn't have any amenities, and now we're 15% cheaper, but we cut maybe 25% of our cost off. And a lot of maintenance, and a lot of overhead.
So how big are these properties? How many units?
These are what? So the one we're doing right now is 180 units. It's a two-phase project. We'll do roughly 90 units right off the bat.
Yeah,
the land is
they're good sized they're good sized properties. It's just and they're ground up development. They're brand new.
Yeah, so they're just like the old garden style used to be, right? So you used to have a garden style apartment that was really nice, didn't have anything in it but units and garages.
Right.
We've even went so far as we're taking the garages out. Because usually people don't park in them, they're just storage. They're not necessarily necessary. I don't know if if that makes any sense, but if you could use those words in English, but it's one of the things where you can cut it out, and if you give people the option of getting the upgrade, a lot of times they're not taking it anymore. So all these C-class things that we have that are workforce housing that used to be A-class when they were first built, with their garages, most of those garages are empty is what we're finding, unless you include it with the rent, but you're not really getting a rent bump. So we're putting this all together, and it seems to me that a garage is too expensive for what the return you get for it. So let's start cutting them out. We tried it, and it has been working fantastic.
That's all.
And we have room on the property if we do need to add a garage later if it doesn't work. So we can take that open air parking and turn it into garage parking.
Awesome. What market are you in, so that people know?
The majority of our development now is Sioux Falls, South Dakota, and they're having a big growth spike, and so they're going from $250,000 or $250,000 community to a 500,000 person community, and they have the infrastructure basically in place to just continue this growth. Wow. And they have tons and tons of jobs.
What's driving the growth?
Healthcare, banking, ag. Very diverse economy, and then plus with ag, you're pulling commodities out of the ground. Whenever you have a commodity that's valuable, every year there's cash product there.
So so I saw in one of your documents that you had units during the prior oil boom. So is this area prone to be? No,
so that's North Dakota. North Dakota is the oil boom, and we got in on a flood cycle and out at the peak oil boom somehow. That one worked out great for us. Fantastic. But that market booms and busts. The market we're in is very steady. It doesn't boom or bust.
Gotcha. Okay. So you got into that market in the past, but you're not in it right now.
Right. It was more of a quick cash flip type of thing when we were doing a lot more hands-on work in my earlier career, for sure.
So talk about your earlier career. What were you doing before you got into real estate?
Well, I started as a roofer. I went to school to be an engineer, and then I just realized I don't want to be an engineer. I don't have the same kind of mind as my dad. It's similar, but everyone in my family is an engineer, and I kind of have a little different mentality. I wanted to work for myself. I thought it'd be harder to work for myself.
So is that how you're different? It's just that you wanted to work for yourself, or you said your mind is different?
Yeah, I don't know. I don't know. My personality is a little different. I'm a little bit more wild. It'd be hard for me to work for somebody. Like, I don't know how I would do it.
I just had a feeling you were going to say something that was, out there in terms of the difference between you and the rest of your family.
No, I mean, I have an autistic side, I guess. I feel like sometimes I'm on the spectrum. Self-diagnosed, of course, but my son is on the spectrum, and we do a lot of things exactly the same. So I'm very insensitive. I have to like turn into a different person to have empathy. I have to think about it. Like I have to be, just become a little more aware or something.
That's
I
funny.
can be kind of robotic, I guess.
That's funny.
So criticism doesn't really hurt me. It doesn't really affect me very much at all. I can still just go through that kind of stuff. So I have a little bit thicker skin. And so I don't know. I'm a true entrepreneur at heart. I have kind of been my whole life.
Well,
So I went into roofing, and then I realized that every time I went, I wanted to do the next step. And I was like, hey, I like these houses better than I like being up on the roof. And I was like, let's start doing this, designing these and building these. So I started doing that, and we started renting some of them, and we realized that renting them was the best long term because we would sell an asset, and then we just wouldn't have it. We'd make a few bucks, you'd buy something, and the money's gone, and you don't really know where it's at versus buying an asset. It's just always right there. So it's like a forced savings plan. So we started realizing that was good. Then we started scaling and expanding because I thought that's what you're supposed to do, but I was going in all types of different directions. Like instead of just scaling into multifamily, I had a division that would do single family homes, custom homes. We would start whole affordable housing developments. We were buying flips. We were buying flips apartments. We were buying flip houses, flip apartments that we'd keep. We're buying some downtown stuff, some historical stuff. We were trying to fix up the downtown. We're just doing everything, building multifamily as well, and asset manager, property manager, all that stuff. We shed the property manager fairly quickly, but we still we did everything.
That's a lot.
So I just ran into a spot where we just were flatlining. We felt busier than ever before. We weren't making any money. So I went to a syndication thing in Nashville, I think in 18. And that's where I met Omar, who I partner with currently. And I learned that you have to scale into one vertical silo, basically, like Warren Buffett always says. You got to focus intensely to make the most money. So I really like multifamily. So I really focus on multifamily. And it gets easier and easier for me to turn down deals that aren't multifamily all the time. And I just continue to focus on the multifamily, and it just gets easier. Now a 150 unit project or a 100 unit project is, easier than it used to be to do a 30 unit project.
So part of that is the knowledge. Part of that is mindset too, right? I mean, like in the beginning,
yeah.
Some people think they could only get involved in something that's small. Like, that's all they could think that their mind could achieve. And then all of a sudden you start doing these bigger deals and you're like, these bigger deals can actually be easier and it's scaling more. So, but your mind has to believe that you can do it.
100%. And I believe that you have to scale. You can scale slower than you think as well. Like you can go from 1 unit to 2 units. You don't have to go from 1 unit to 10 units to 50 units. You can go 1 to 2 to 4 to 8 to 12 to 20 to 40. But once you get into that roughly 40 range, it becomes it doesn't matter. You can't really make an impact by yourself anymore. So you can't rely on yourself to save any projects, I guess. That's what a lot of people think, like, oh, well, if this goes over budget, I can go do it. Or if this happens, I can go and be the PM and save the 7%. Well, once I get to a certain point, that's not feasible anymore. So you have to make it figure out how it works. Once I think you get to that scalability point, now it doesn't matter if you do a 40 unit or 120 unit. It's all about just collecting the money, I guess. So as long as you build out your investor base and you can collect all the money, that's only going to be your only hurdle. That's the only part that's different.
I agree. And when you were talking about doing 1, 2, 4, 8, I had somebody that came on and he said that he had that goal set. So he was 1, 2, 4, and then he was like, when he got to I think 8, he was like, you know what if I change that goal from 8 to something bigger? So he went from 1, 2, 4, and then I'm like, so what did you make it? He's like 800. I'm like, holy cow, like that's a big difference, 8 and 800. Like, and so where'd you end up? He's like 424. And if he had, the goal of 8, he probably would have ended at 8. But he thought he could do 800, or he changed, he moved the goalpost down further, and he didn't get there, but he got a whole heck of a lot farther than he originally thought he could, which I thought was really cool.
That's awesome. Yeah, I think it's almost all about mindset. Pretty much every decision that you make comes down to mindset. And so, are you making emotional decisions with a small mind, or are you making rational logic decisions with an expanded mindset? Because I don't know, you hear a lot of negativity and stuff, and then you ask people, well, how often does that happen? And they're like, it's never happened, but it might. And I was like, well, why are you, like, if you've clearly this has happened, all this happens 99% of the time, and you pull out a never going to happen, why do you put more weight on the never going to happen than the 99% of successes that had happened before? So.
And what are the answers that you get back?
They just don't really even see it like that.
Right.
They just make up, and they're just emotional by that point or whatever. So then they just
people are afraid to lose, right? I mean, more people are afraid of that 1 in 100 time of losing than of winning the other 99 times.
Yeah.
So, I mean, you probably have friends or people in your network that are like, dude, Dusten, how'd you do it, man? Like, and you might even spend time like teaching them. And then there's some people that they'll grab a hold and they'll learn, but there's some people that it doesn't matter how much time you spend with them. They're just not going to take action.
Right.
Because they're afraid.
Yeah. But I say, people ask me that now, and I used to tell them, like a few years ago, I used to just say, persistence and this and that and whatever traits that I received. But now I just say it's all God. I control like 1%, which is my effort, and the other 99% is all this stuff happening perfectly around me in this whirlwind that just tends to happen in my favor all the time. And I think when you operate on a certain mindset, that's what starts happening to you.
No, that's great. That's great. When people talk about like multifamily as a team sport, I think that, if you have God on your side, that's the best team member ever, So you could have a lot of other stuff happen, and you could figure out a way, with him on your team. So talk to me about the South Dakota market. I don't know much about that market. So, what is that market like? Is it more like the Midwest where it's a cash flowing market? Is it?
Yep. It's a cash flowing market. It's definitely not a high appreciation market, but it can be at certain times, and it can cash flow so high that it's just worth being there. Depending on when you develop, you force so much appreciation. So when I look at that, when I develop, yes, there's a lot of appreciation, especially in the first 5 years, massive amounts, because getting the building totally stabilized. So I am forcing appreciation. I feel that in this area, there's more of an opportunity because there hasn't been such a focus on design. It's always been a focus on value since ever I can remember. So the majority of apartments are value-based. So if you separate yourself through design, there's this massive pool. And with the Instagram age and everything, it's like, it keeps getting more and more like the HGTV, everyone's more aware. And so then you have these trendy units, and there's just not that many in all of the market. There's 20,000 units, and maybe 1,000 of them are nice, and 1,000 of them might be nice, 2,000 might be nice, but then they're still not that great a design. So out of them, maybe 500 have really, really good design. So, and most of the stuff that has good design is condoed, so it's not rentable. And so that's what we do. That's where we separate ourselves. But our occupancy is almost always at 100%.
Wow.
And, we try to raise rents to a certain point, and we feel like we've hit the max rent, and we can still fully rent out every unit. And so our occupancy is very, very high with the design that we do, and our concessions are extremely low. Our bad debt is almost zero. Our marketing is actually very low because we do a lot of organic marketing through Facebook and different posts and just talking about our projects all the time. Lots of times developers are old and they don't like social media. So if you're developing you're putting everything on social media, you're like the only one talking about yourself. So
I could see that, you know. I mean, and, you know, to be a developer, typically you have to have funds, right? I mean, so people are typically older, you know, to have developed, to have the capital to do that. So you have one partner, is that?
No, I have two. I have
partners?
two main partners, and then, you know, we have other co-GPs and stuff. But the two main partners that construct everything are Caleb Veldhouse and Omar Khan. Omar Khan is the financial. He's a CFA, so he's a brilliant numbers guy. And then Caleb is an attorney that decided he didn't like being an attorney as much as he liked developing and having a general contracting business.
Awesome. So talk about developing versus buying. You've done both, buying existing and developing. Which do you like better? Which do you think has the better returns? What are the different, you know, risk profiles?
I think the overall better return is always development, because you always add in a lot more vacancy and concessions and bad debt than normally happens on development. So the upside is much higher. Everyone wants to live in a new place, so they're easier to rent. Your income seems more steady. I guess on an older place at times you can have a little more cash flow here and there, although not with the rates now and the pricing now. So in my opinion, development, you can just always develop, and acquiring, you have to pick and choose your spots when you're going to acquire. It's like right now, it's really hard to acquire unless you're getting off-market deals or cold calling old owners or buying
because the pricing doesn't work.
Because the numbers the numbers are just tough for me, right? So an insurance company can come in and buy it.
Yeah.
But they're not giving so much of the money. You know, they only need a 5% return or whatever. We need to provide like 20%.
Right. So what's the equity like in your deals? Is it you and your partners? Do you bring in equity partners? We
raise capital. We use some of our own, and we raise capital. We're doing so many deals right now that we'd never be able to fund them ourselves.
Okay.
And we're usually in between that 10 to 20% of each deal we fund. That's how much money we put in there. And then we are always fronting the project. And so we use our cash at the beginning, take it out so we can use our cash for the next one. So we are using more cash and more resources than it would appear from, you know, just looking at how much money we put in.
So how do you end up going about finding new equity partners?
Well, we just talk to everybody and, you know, say, hey, you want to come out, check out the project. We love to discuss real estate people and show them what we're doing, why we like the market, where our current contracts are on new chunks of land. So we like to just explain what we're doing. We're trying to get to 1,000 units per year. So we definitely need to be able to raise a lot of equity. Like right now, our raise is roughly $5 million, and we got like $11.5 million of debt. You know, so we'll need to raise something like that again in another 2 months, and then another 2 months after that. So we have deals lined up where we're trying to get to 1,000 units. So that's roughly going to be 10 deals a year.
Awesome. That's awesome. How do you set up the deals? Do you set them up as individual syndications? Do you set up a fund that you're raising into?
We do it. Right now we're doing individual syndications on every deal because I personally like that power. But we don't like to have to do all the attorney work every time. So like we're trying to figure out how we can do a fund model and how can we just raise the funds and then put them into this LP structure? You know, so we're still learning how to do that stuff. We can accept 1031s. We're getting really good at accepting 1031s. We've had a 1031 exchange and a tick on every one of our past 3 deals. This deal we're doing now is no different.
Are those repeat 1031 guys, or how are the 1031s finding out that they can get into your deal?
Well, I did 2 1031s myself, so I'm a repeat 1031. Okay. It's my own. The other guy, no, he only had that one 1031, so he is not a repeat. We had a repeat on a 1031, but somehow they had handled the initial part of it, and they didn't get introduced to our people soon enough, and so they kind of botched up the front end of it. So he ended up having to not 1031 and bring his money in, but so most of our customers are repeat though, for sure.
But that's an interesting one because, like, now there's a big time crunch on 1031s, right? So you sell your deal, you got to find a new deal, and then if you're running up into the time constraints, some people don't know that they can invest in another syndication with that 1031, and so that's a nice avenue, and it's kind of it could be kind of passive because there's already partners that are managing the deal.
Yeah, it would be passive unless somehow you came in and took the entire thing down. Then we've had nobody do that yet, but it would be a possibility. If someone did that, then they would be obviously not passive. They would have some sort of role. I think they'd have to, but yeah, that's why we're trying to get the word out about the 1031, so you don't go and start the 1031 before contacting us, because it's so easy if you just have the right people involved right away.
Right in the beginning.
Yeah, because they do all the work. You don't have to do anything. You just let them do it, and it's not that bad. The process is easy for the investor.
So now that you started out with small, like duplexes, and then grew from there. I mean, I think you started back when 2005.
2003 is when we got started.
Wow.
Yeah.
So 20 years you've been doing it. So you started with duplexes, and now you're doing 180 unit deals. Like, do you go back to doing duplexes? What do you like better, small or large?
I like the small stuff for the experience. Like, if you want to get experience, you're way better off screwing up a duplex, and you can go in there and you can help yourself out with some jams. You screw something up on a 180 unit, and the whole team feels it. I like, though, the fact that I get to design cool, neat stuff now, like bigger stuff that's in the public eye. I get to provide architecture, which is technically public art. So I've always kind of been artistic, and so to be able to provide something like that, plus provide a lot of times it's affordable. Some of the luxury stuff's not affordable, but we provide a lot of affordable housing and really, really nice living conditions for people. So I really like that too. So I like the idea of doing more units. I like the idea of when I do more units, I have all these people under me that I can help, and I can provide a lot of knowledge and experience for those people as well. And that's cool to kind of spread that.
That is cool.
Real estate knowledge.
Have you gotten involved in any low-income tax credit type deals?
No, not really. I mean, we use vouchers on some of our stuff, but we have not. But we are starting to look more into it now that we are, now that rents are getting so high that we might be able to make some of this stuff pencil to have so much affordability in certain units.
Right. Is the community looking for more of that as they grow?
I think every community, in every area, except for maybe some super wealthy communities, are looking for this.
Right.
Because if you also do the low-income housing properly, you eradicate crime as well. Because if you light it up really bright and you do some certain things, now you're giving and providing an even safer place for that demographic. And so I think that it does improve, and so when it's placed properly and it's done properly, the neighborhoods appreciate it. But I think it's needed everywhere. Basically, trailer parks that aren't trailers, they're just houses, and that's kind of what is needed almost across the whole nation.
It's crazy, and you're true. It's true. I mean, people are spending so much of their percentage-wise of their income on housing that people need an affordable place. So what about inflation? How does real estate help investors stay ahead of inflation?
Because it rides the wave. If anything, I mean, it's cash flowing asset. You're buying a business. So that's the beauty of real estate, is that you got to remember you're buying a business. So when we're developing a property, we're adding tons of value because we're starting up a cash producing asset on ground that's not producing anything and is a liability. So you're turning something from a liability to a cash cow. And when you do that, there's tons of value created. Someone will come in and buy it for way less than you have into it. So we develop in place at roughly an 8 cap, something like that. And we can sell these at in between a 4 and a 5 cap because they're very desirable locations. We find though that most people don't sell these things. They keep them. They seem to keep them. So it's harder to buy the nicer stuff for sure.
That's interesting. Now, I've heard. Do you keep your investors in all the way through, like lease up and then hold? I've heard some people that will bring the investors in, like buy the raw land, get it entitled, then some investors get out, and then some new ones get in at that point, and they'll take ground up and through lease up, and then they get out. And
so
others will hold during the whole period.
Yeah, if we create a land bank, which we're kind of close to doing, we'll need to do that exact strategy. But what we are doing at this point is that when we create one of those deals where we both buy the land and make it something, we create so much value that we have the investors that we do let in, we make them put that money then into the new deal as well, because they're more than doubling.
I met with one guy, and he said, he loved to help people, just like what you're saying, but he would talk to people that would reach out, and he would never know if they did anything. So he started to charge for coaching, not because he wanted to really make a lot of money off of it, but because for the same reason, he wanted to know that they were actually doing something. If you're investing your time, you want to know that the person's going to take action.
Yeah, that is a thing. I think that immediately if someone's interested. It feels like they just quit reaching out almost instantly. You start holding them accountable a little bit, and that some people continue to call, and you kind of want to help them as much as possible. I think it takes a long time. I don't think people can just get your advice and go do anything. I think it does take years. So you do have to have a lot of patience with it too. I just treat it as like if I'm helping these people,
and people have helped you, I'm sure. Like most people that I know that are successful, they've had help along the way. They've been willing to ask for it, and when they received help, they took that and used it. But go back to when you got started. How did you end up getting into the game? Like, did you use your own capital? Did you have a mentor that you went to?
Well, no, my mom helped me.
Your mom helped you.
My mom helped me. Yeah, but I get help from people constantly, every day, constantly. People do stuff for me, help me. I'm super blessed in that regard. But yeah, my mom put up the money and I put up the work.
Awesome. So she believed in you, and then you had a track record, and then you were able to parlay that into more deals and then grow from there. And now it's 20 years later, and you're doing things that the community is doing write-ups on. Very cool. So do you get involved with going to conferences and speaking? Like, what's your take from that perspective?
Well, I don't speak too much. I'm terrible at doing that, which I'm not supposed to say that because I'm supposed to say I'm good at it. So my mindset will think that, but it's like one of the worst things I can think of is to speak publicly, but I don't mind being in public and speaking. I just don't like to get up there and like, oh, you're relying on me to have this great speech, because that's definitely not me. I wish I had that charisma, but I can have that charisma sort of just on the Q&A side. So I like to be involved in panels, things like that. I don't know. I'm just not into speaking. I don't really want to prepare a speech, all that stuff. Speech was one of my worst classes. I did okay at it, but it was still one of my worst classes. And just one that I dreaded all the time.
What about just networking with other real estate investors? Do you do that?
Oh yeah, that's easy for me.
And what value do you get out of doing that?
Sometimes I meet some awesome people. Sometimes I just have a conversation. Sometimes, to be honest though, like some of them conversations, I get zero value out, but that's just how it goes. Sometimes personalities don't mix that just move on and go to the person that you do. Like one guy, I might never see him again, but he told me all about airplanes and how they worked and how commercial pilots move around, and it was really cool. Nothing. We just didn't talk anything about real estate. I was just talking to him about his cool
That's
job.
funny. That's true, though. I mean, that's true with going to conferences, right? I'll go to a conference and I'll see, 6 speakers, and I'm like, no value, no value, no value. And then all of a sudden, the 4th guy, I'm like, holy cow, that's a great idea. If I apply that to my business, like I could really, blow it out. And you had to kind of sift through a bunch of stuff to get to the good stuff. And I think talking to syndicators too, it could be done that, nothing new. And then all of a sudden, whatever, somebody had a fire at their property, and then you kind of just have it in the back of your head. And, if all of a sudden you have one at one of your properties, you could call that person. You're like, how'd you manage through this? How'd the insurance company work? And so you have these conversations, and you can use that as to, or, hey, we did this type of value add play. Like for me, with talking to you, I've never talked to anybody that's focused on a new development, but is taking out all the amenities, right? And so that's really an interesting concept to me,
Yeah, I mean, I met my really, really good partner, and at first I didn't think it was anything, and somehow we're like really good partners, like almost as good as it gets in any type of partnership. And so I met him in Nashville at the first Jake and Gino conference.
That's crazy when people talk about. So there's some people that are like, I think that these conferences are a waste of money. And look, it can be, right? If you go there and you just listen and you don't take any action, but there are people, and you're proof right there. You went to a conference and you met your business partner. How long have you been partners with them? 5 years.
5 years now.
You met your business partner from that, going to that conference. I joined a multifamily mentorship group in the Dallas market. I met a gentleman from Chicago, and I partnered with him on my first syndication deal. Like I never would have met him had I, not been involved in this group. So you never know what's going to happen, but you still have to kind of get out of your comfort zone and talk to people and tell them what you're looking for.
Yeah. Definitely.
So where do you think the market goes from here? I mean, look, everybody's been, I don't know.
Where does I think the market goes? I think it goes higher. I think it goes higher. I don't know how long it's going to take to go higher, but what I think is that we are somehow normalizing these insane prices right now. They're just getting normal to us. Psychologically, we're going to figure out how they're worth this value at this interest rate. And when interest rate drops, it's going to compress the cap rates. And then it's further going to increase the values. I don't see this huge tsunami of good deals coming. I don't know where they're at. That doesn't seem like they're coming. Maybe they come in 2 years. Maybe they keep the interest rate high for another 2-3 years. Maybe. Most of these deals get bought up by massive companies too. They're just insurance companies gobbling them up, or whoever can write a single check. So those little guys aren't really getting a shot at that. Like they say, syndicators only make up like 4% of the entire multifamily space.
4%.
Yeah, it's not very big.
I didn't realize it was that small.
Yeah, it's mostly institutions and family office and different things. Very few syndications.
It's interesting because I think that there's a lot of, look, transaction volumes are down like 80%. Everybody's been consistent talking about that. Institutions have been kind of off. But I read about family offices, and family offices are like, they are allocating more to multifamily than they were before. So there are people that are going to step into the market and pick it up. And one of the questions I have, because there's a lot of syndicators that I've talked to, they're like, oh, they're licking their chops. Like the second half of this year, there's going to be all these deals. And I don't know if there are going to be all these, distressed deals, you know?
No one's
Right. I
seeing
mean,
any so far. Nobody's seeing them, and there's a lot of people that says they think they think they're not happening. Not for us anyway. Maybe for
and it
some
could
players.
be that if you think about the lending environment, right? I mean, that's where a lot of people say that all these deals are going to come, as the bridge loans that are coming due and this year and next year and et cetera. But, a lot of these bridge lenders, they may be involved in multifamily, but they may be involved in office too. And office is a much bigger headache for them right now. So it's kind of an easy decision for them to say, you know what, I'll just extend it for a year. If you can continue to make the mortgage payments, I'm not going to force, even though you're not meeting the debt covenants.
Who wants to come in right now? Who wants to come in and
Yeah.
take over a multifamily? It's kind of like hotels when COVID hit. Dude, nobody lost their hotel.
Yeah, that's a great point. And they're going gangbusters now, right? Holy cow. I remember when it used to be like $500 a night was crazy expensive. And now, like, you go to try to find an upscale resort in Cabo, and they're like $7,000, $8,000, $9,000
$1,000,
like,
right?
That's crazy, but that's the market. So
Yeah.
you're the second person. I had somebody on that actually dealt with family offices, and he thinks that the market's going to continue to go up and that we won't have another recession until like 27, 28. And
Yeah, I think the inflation is just going to wipe out all this debt. Kind of like your debt doesn't look as bad once it all inflates away.
that's true. It's there's been so much talk that this recession is going to hit, and that these higher interest rates are going to cause all this distress. And look, I'm seeing distress. If you're an LP in all these deals, you probably see it too. I'm an LP in a lot of deals, and
Oh yeah,
and I've had distributions cut. I've had distributions where I'm not getting them anymore, because cash flows being negatively impacted based on higher debt service. But it's a matter of, can people hold on and get through it? And also, like, a year from now, are interest rates still where they are, or are they lower? Who knows?
Yeah.
So,
Yep. I mean, who knows where they're at? I know that eventually, though, the real estate's going up all throughout history. It always goes up. And if you even look at markets that used to be dominating the world, like Dutch, England, you look at them and their real estate's still sky high. It never went down, and they lost their world economic status and everything.
yeah, I don't know. Like, what I tell people is, I don't know what's going to happen in 3 months, 6 months, a year. But, I'm in Dallas. I don't know about some other markets, but here, 3 years, 5 years, 10 years from now, I just think there's going to be more people living here. There's going to be more, competition for apartments, more jobs, more income. And I think that real estate values are going to go up, over the medium to long term. I don't know what's going to happen in the shorter term. That's the.
Yeah. No matter where I go, and when it's a desirable area, no matter what community, you go to the desirable parts of that community, it's all new and nice. It's all full. Every apartment that I want to buy is almost always full, no matter if we're in Atlanta or Dallas or Sioux Falls or wherever we're at. Everything's full.
Right.
It's crazy.
If it's full, and then single family, people are sitting on 3%, 4% interest rates. They're not going to sell their house, right? Like, what?
Yeah, and those don't balloon at all. Those are 15 or 30-year mortgages. They're
right.
They
so
never have to
they're
pay
just
those.
going to sit there. And so, in any event, so you've done a ton. Where do you go from here? Like, what's your next big stretch goal?
Now we want to vertically integrate. We want to do wall panel factory, so we buy all our own lumber, trusses, all that stuff. We want to create all that, vertically integrate That can be another facet. And then we also wanted maybe do some development in a place like northern Dallas.
That's where I live. So you come to Dallas, you look me up. It's going gangbusters here, and I live close to where they just put in the PGA headquarters, and so I went to the senior. It was one of the major senior PGA, one of the major events, and it's like a $500 million property, and like that's just one development. Then there's another development that's going up that's going to be several $1 billion. Like it's just crazy the amount of capital that is flooding into some of these different markets.
Dallas has incredible infrastructure. You should meet with Omar if you're in Dallas.
Is he in Dallas?
Meet with Omar. Maybe he'll want to come. He might want to come on your show
he in
too.
Dallas?
Omar Khan, my partner. Yeah, he's in Dallas.
I think I know of Omar, but I don't know. I haven't met him. But yeah, when we stop recording, we'll exchange info, and we'll get him on, and I should meet up with him for sure. So, hey, if people want to get to know you better, what's the best way for them to do that?
Mailboxmoneyre.com, as in real estate. Mailboxmoneyre, as in real estate.com. Mailboxmoneyre.com, and that has all of the portal, the email. You can reach out to me on Calendly. Everything's in there. You can see what we've been doing lately, our Instagram links.
Well, I appreciate you sharing with the listeners. I really like the fact that you've got a different angle. Now, was anybody else doing that, the different design, or did you just have a vision for it and then decide to do it?
This is just what I've been doing. I've been able to take liberty because I live in a fairly liberal city. So I've been able to, they've granted me the liberty to do some really cool stuff here. And so when I saw cool stuff happening in Minneapolis or Colorado and like at the epicenter of where the cool stuff happens, I would try to somehow bring that back on a smaller, cheaper scale and do stuff like that here. And then they allowed me to continue to do that. Like most banks would not let you put in a whole apartment full of 30 studios when no one's ever done it in town. They let me do that. So I got away with a bunch of things that normal developers, for whatever reason, wouldn't be able to get away with. Maybe I was able to sell my vision, whatever, they took a chance on me. But it worked out really well because you start realizing that people actually want to live this way. And they're prevented from doing it from the system because the system doesn't have comps, so they don't want they want to put that in the system. So you kind of break into the system, and then you're way farther ahead of everybody, and you figured out how you can sell it as well. So a new guy might come in, and the banks might not let him do all studios just because very few people do that.
It's very cool. No, I applaud you. Well, I appreciate you coming on. We'll talk after we stop the recording and talk about getting together with Omar. And listeners, I hope that you enjoyed that one. Definitely reach out to Dusten, and we'll talk next week. See you.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.